Now we're talking about term policies. Term policies typically are going to be for a little bit of a younger crowd. The 70-year-old probably is not going to be in the market for a term policy. Most of the time a term policy is going to be used to cover, let's say, a debt, a mortgage, protect your family while your kids are young and your kids are dependent upon you, the parent. And it's going to look like this. You got a 30-year mortgage, and you want to make sure that if something were to happen to you, your wife would not be stuck with this fat mortgage that she's not going to be able to pay. And you want to cover that mortgage. So you're going to say, I've got a 30-year mortgage, I'm going to have a 30-year term. This policy is going to work in a way that you're going to pay a monthly premium. It's going to be very reasonable, very inexpensive for a term policy. And if you were to pass within those 30 years, your beneficiary, your wife, is going to receive the full death benefit. Once there's no longer a need, once that mortgage is paid off after 30 years, the policy actually ends. The policy ends, and there's no cash value to a term policy, but it is going to be the cheapest way to insure you for your family, for whatever the need is a term policy. One more step, or one more thing that we can talk about with a term policy, there's policies that are actually return of premium term, and those can be attractive because at the end of your term, let's make it up and say that it's just a 20-year term, all of money that you've paid into that policy you're going to get back. All of the premium you're going to get back. So if you don't die, you get all your money back. If you do die, your family is protected.